1996. In June 2023, she did a certificate course on circular economy and sustainability strategies from Cambridge University. Her areas of practice include corporate advisory, mergers and acquisition, advisory and valuation, direct tax advisory, succession planning, and family arrangements. She has served as an independent director on boards of several listed and unlisted public companies engaged in manufacturing, IT, and insurance sectors. Ms. Desai has a rich blend of experience in valuation and corporate restructuring and has advised on transactions of India's largest publicly listed within the telecommunications, financial services, manufacturing, and consumer product industries. She has provided valuation advisory services for intangible assets, open offers, shares held under FEMA, and for transfer pricing studies. She is an independent director on the boards of several listed and public companies. Ms. Desai served as the vice chairperson, Western Indian region of the Institute of Chartered Accountants of India during 21-22. As a member of the subgroup formed under the Valuation Standards Board, she actively contributed to the drafting of the standards. She oversaw the collation of the WRC Reference Manual 2021 and has contributed many articles and lectured on the areas of focus. Thank you so much, ma'am, for getting out your crucial time and be here with us to give us an insightful intricacies in the mergers and acquisition valuation. Before we start, on behalf of the institute, I would like to share the memento for her. Along with, I would call the moderator over this dais, Mr. Ronak Singhal. Thank you. Please give them a round of applause and please get the memento. Just 30 more seconds probably for a short setup. Ma'am, mic.
Hello. I'll ask. Thank you very much, ma'am. First of all, for accepting the offer, for accepting to come and speak. Ma'am, so we have received a couple of questions from the audience in advance. I'll be asking those questions to you. This is regarding merger and acquisition valuations. So the first question is, what are the multiple regulatory framework and compliance complexity involved in performing M&A valuation in India?
So, Ronak, as you know, this is a it's an evolving field, but now one can say more or less it's quite settled if we see this M&A space. So let's start with the legislative, the way it has evolved in the legislation. So as we know, earlier there was a section 391 to 394 which governed mergers and demergers and any restructurings between companies and the shareholders. Under that section, there was no requirement for any valuation report. However, there was always an item in the checklist which the high courts had come up with, because how do they okay, or how do the shareholders or the boards okay a particular ratio? And that is why then there was an item in the checklist which required that there should be a valuation report for any ratio which is there in the scheme. So this is how it was earlier. Then the company law underwent a change, and now we have section 230 to 234. Now under these sections, if you see, you need to have a valuation report from a registered valuer, because now any valuation which has to be carried out under the Companies Act, it has to be done by a registered valuer, a person who's registered under section 247 of the Companies Act. Now the section 247 was there in the Act from the time that 2013 Act came into force. However, the rules under the section 247 were formulated much later, almost I think 3-4 years after it came in. So I think in 2019 or something, the valuation rules and the standards started coming in. So now the situation is that the valuers are governed by the registered valuers rules which are under the Companies Act. Now under the registered valuers rules, one needs to do valuation as per the valuation standards which are prescribed by the registered valuer organization, or if the registered valuer organization where the member is registered does not have its own valuation standards, then one has to go with the internationally accepted valuation standards. So IVS, one can say. So we have, the ICAI has come up with the Indian valuation standards, and then there are these international valuation standards. We can say that more or less the valuation standards in India are aligned with the international valuation standards, because that was actually the requirement even of the MCA when they were pronounced. That was actually the requirement, that let's have an alignment between the international standards and what we have here. Now one will say, what is there in these valuation standards? So that's where I'll take you back to the judgments which were pronounced way back, So I would take you back first to Mahadev Jalan. So in Mahadev Jalan, there were different types of scenarios which were discussed, and it said that if it is a particular scenario where the company is ripe for winding up, then in that case one should go with the asset-based valuation. In case of a company which is a going concern and it has steady profits, then one can take the maintainable profit and do the valuation. So these are brilliant judgments, and it's a very nice judgment, Mahadev Jalan. Then came Hindustan Lever. Now, when we look at this judgment of HUL, it is how it departs from Mahadev Jalan is that this judgment now says that you can take a combination of approaches, right? In a relative valuation, you can take a combination of approaches. You need not just go with one approach. Mahadev Jalan actually compartmentalized that if it is this type of a company, then you go for this method. If it is the other, then you do the other method. Hindustan Lever departed from that, and fairly so, because one cannot just go with one approach always. Maybe there are situations which require in certain cases to go with a particular approach only. So it's not that in a relative valuation you have to have matching approaches. More or less in a relative valuation which is required under a merger or a demerger, one should strive to have matching approaches, and one should strive to have acceptable weights given to the different approaches which are used for valuation. Now we park ourselves here. Now we come to the valuation standards. Now the genesis of valuation standards is in the convention which was always followed in the market. So if you look at the valuation standards, you read through everything, the business valuation standards and all, it basically talks about what is anyway the accepted market norm. It's just that it codifies it. So it's a good thing for valuers to have a codification, because you can have a fallback. If somebody challenges you, you always have a fallback that you have these valuation standards who prescribe that this is how you're supposed to go about valuation, and this is how you're supposed to disclose things in the report. Now, so in this valuation standards, there is again a separate carve-out for relative valuation, which is typically required in case of an M&A. And that says that you can use a combination of various approaches, and of course giving different weights. So there are different approaches which are discussed. There is the income approach, there is the market approach, and then there is a cost approach. And there is also liquidation approach, which I had insisted that we have to put in, because everything will not fall into cost approach. There may be situations which will fall into liquidation approach. So that's where we are insofar the valuations are concerned. Now we come to the other regulations, that govern valuations. So even when the Companies Act did not have any requirement for a valuation from a valuation valuer, there was always a requirement from SEBI. SEBI in many places required valuations from chartered accountants. And in case of mergers and all, there was always a requirement to have a valuation report, and then they brought in that the valuation should be, or the ratio should be also evaluated by a fairness person, and that has to be a merchant banker. So now when we come to the SEBI part, now SEBI has, it's pretty, it has been evolving continuously. When we look at the SEBI regulations, they are evolving continuously. So there are two parts here when we look at the SEBI regulations. One is that you have things which are codified in the regulation itself, and the other is certain things which are not necessarily in the regulations, but SEBI has asked the stock exchanges to mandate that by way of the checklist. So there are these checklists which are given by the stock exchanges. You can go on to NSE website also, and you can download those checklists which are there. And again, over there are certain requirements. So now I come to the requirements under these checklists. So when we look at the so NSE's master circular, the latest one which is prevailing, there is a requirement, and this has been brought in by NSE at least I would say 3-4 years back. So it says that so how it evolved was that it said that if you have done valuation basis, cost approach, then you should rely on financials which should not be older than 3 months for the unlisted company. And in case of income approach, that did not apply. That was the situation earlier. When NSE did not have this on the checklist, but it used to give a case-by-case letter to every company which made an application. Then we came to this stage where now it is specified in the checklist with a modified language which says that the financials used for valuation should not be older than 3 months. Okay, so which means, and they should be audited. So now we have this requirement that audited financials not older than 3 months should be used for the purpose of valuation. So we have this very peculiar situation, right? Because all the listed companies, they undergo LR. To undergo a full-fledged audit is not possible for a company in the middle of nothing, right? So in between a year, it is very difficult for a company to undergo a full-fledged audit, and with the Ind ASs and everything, it's absolutely impossible and prohibitive insofar as the costs are concerned. So now, as a practice, when we see the stock exchanges and SEBI, they accept limited reviewed accounts. Although in the checklist, it still says audited financials not older than 3 months. So we have to take the limited reviewed financials. So that is one. Now, the other challenge is, normally the limited review is finished within 45 days of the quarter closure, right? Now, normally, means we insist that you give us something, but companies, listed companies, are not willing to part with the, the audited numbers before they are published, because there is so much about all this UPSI, and although once you become part of UPSI, in fact then it is much better for a company to share information. However, but then what happens is that the time available for a valuer to complete the valuation is very little, and to do all the filings, because you need to file before the closure of that 3-month window. It's a very, very tricky, and it's a very tight situation that regulator has forced all the companies into. And that is why if you see in the first 45 days, it is absolutely impossible to, actually file a scheme, because you'll always overshoot that 3 months period. And you will have to file after, the financials are out. But again, when we come to the valuation, methods, the methods of valuation, one is the comparable companies multiple method. The comparable transaction multiple method, that is okay. But when we look at the comparable companies multiple method, you need to have numerator which will be closest to the date of the board meeting, because your valuation date has to be maybe 1 day prior to the board meeting or the date of the board meeting. And when it comes to the denominator for comparable companies multiple approach, that denominator will have to be based on the financials, say profits, EBITDA, PAT, or book value, or AUM, or whatever you are valuing, you'll have to consider those aspects. Now, if you have your company's financials, say of 30th June, the company has done the quarterly audit committee meeting, say by July, end of July. So you have the financials with you, the quarterly or limited reviewed numbers. But for the comparable companies that you are looking at, you may not have, the denominator which is matching. Now, if you are going to have, say, March numbers, and supposing in June, the numbers undergo a little change, then you will have, say, a higher or a lower multiple applied to a higher or a lower not matching kind of a variable. So that's where there is some challenge that one faces. So it's best to have it after 45 days of the quarter closure, because that's when you'll have the financials of all the listed companies. I think I've covered most of the things, yeah.
Sure, ma'am. Thank you for the detailed answer, ma'am. Ma'am, so here we have many professionals who deals in business valuations and financial reporting valuations. They wanted to ask, what are the common information related challenges one professional face, and how do they impact the overall valuation methodologies by performing a M&A valuation?
Yeah. Okay, so one thing which I should have mentioned this, it's not really documented anywhere, but it is a convention which SEBI has started following, that they want that you should also capture the discounted cash flow approach of valuation. That's where your data challenge comes in, because most of the listed companies would not want to share the projections with you, because they say that we are not even allowed to, make public the projections which we have, But then SEBI counter questions that how is it that such a large listed company doesn't have projections? How can a management function without having a visibility or some roadmap for future 2-3 years? So you need to have projections. So the argument that we valuers used to put up, that the company doesn't have projections, that is not tenable. One has to take the projections from the companies, otherwise it goes into a very lengthy process. So it's better to do valuation, carry out DCF valuation wherever applicable, and put it right upfront in your valuation report. Now, what happens, the other problem that people face is that after the valuation is, after the board meeting and the filings are done with stock exchanges, there's a requirement that you file your, valuation workings with the stock exchange. Now that is the challenge that people face, and companies don't want to share their detailed projections. So then of course, when it comes to filings with stock exchanges, at least insofar as the cash flow projections and all are concerned, it is accepted by them also that we file in a concise way that which doesn't give out the company's total, detailed projected outlook. So this is one big challenge that we face when it comes to data and sharing it with the regulator.
Right, ma'am. And ma'am, the next question is on the consideration. So in an equation, if the consideration changes from cash to shares, then how does this impact the overall valuation in M&A?
Yeah. Okay, so here I will talk about even tax bit a little bit because, okay, so when we have a merger and if there is consideration in cash, then it will lose the exemption under 47. So in case of most of the mergers, people will always have equity shares, preference shares, redeemable preference shares, something like that, so that then they can even encash that at, after certain milestones are reached and all. So you can structure the transaction in a nice way. So generally, in case of all these mergers, demergers and all, people don't really go for cash consideration. I won't say there won't be any. Supposing there's a shareholder who's getting a treaty benefit. Okay, in that case, he can afford to lose exemption under section 47 because maybe there are other commercial considerations at play, and so it is better for him to take certain cash consideration out, and so it's all above board, it's nothing. But in such a case, there may be a cash consideration. So most of the mergers, demergers, I would like to say, will have all shares and redeemable preference shares or convertible preference shares or equity shares. Now, when we when we come to supposing it is a cash consideration in case of an acquisition, which is a slump transfer or something, which is not through NCLT process. So that is where you'll have cash consideration. And if you have, instead of cash consideration, you have, say, some shares or some preference shares or something, then one has to go into entire valuation process of the instruments which are getting issued. Now the challenge here is that when there is so I'll tell you why one has to even keep tax law in view when this is done, is because now we have section 56 also, right? So what is the consideration which is given up by the person who is receiving the shares? The consideration given up is the consideration is the undertaking given up or the stake in something given up, and against that person is receiving shares. Now this transaction is not exempt under section 56 to 10, and so one has to ensure that there is a matching of it, means the consideration should not be lower than the value of the shares received by the person. Now when it comes to equity shares, the formula which is given there is pretty simple, just go with the NAV. But if it is preference shares or some other types of preference shares, because preference shares are other instruments,
Right.
then you'll have to ensure that those instruments are also valued and you match it up with the consideration so that you don't have a mismatch. Your consideration is not lower than the value of the instruments which are given. Now there are also some instances where at the time of the transaction, the management may not be very clear about exactly what will be the terms of these instruments, So I have also seen those types of cases where they say that, okay, we will issue preference shares, but we'll decide the terms. So what then we do is that in the valuation report, we'll state the consideration and we'll say that, okay, this will be discharged by issue of equivalent value of preference shares at par. Means the fair value should be equal to the consideration. That is what we state in the report in such cases.
Okay. Ma'am, so we have one more question on consideration front. So if there is a CCPS or optionally convertible preference shares, if that is a scenario in take of consideration which you're getting, then in that case, will it be a normal valuation or should we do the Black-Scholes approach and apply or determine the value of preference shares as we do in normally financial reporting or for accounting purposes. So
Okay, so let's touch upon this option pricing. Okay, so now if one were to do the valuation of preference shares, when you do it under the option pricing method, you will get certain value for the option in case of convertible instruments. But so it's a very tricky situation where you can still get, even if you are issuing at par, you'll still have some upside in the option, because you'll say that there is always a delta between the option price and the volatility that what you're going to achieve after. Okay, I think I'll give you with an example.
sure,
So
ma'am.
it becomes very simple for everyone to understand. Let's take an example. There are convertible instruments which are issued, because I've dealt with this very situation. The convertible instruments which are issued, now there is a certain set of projection which is prepared by the company. So based on that, you know what is going to be the value, say after 1 year, after 2 years, after 3 years, because you can run it mathematically. That's not difficult. So you will know what is the value at those different nodes.
Yeah.
Okay, now I'm talking about that binomial kind of, not really black and Scholes, the binomial model which will
right.
suit better over here. So when we go with the binomial model, we will have volatility, which will be built into the stock price for determining what will be the value at every node. Now, this volatility and the value of the stock basis DCF may not be the same.
Right.
So I would say that it's a very tricky question.
Yes.
How do you want to use it? It can also help you in to fend against impairment in your
yes.
books also. So there are various things one can do here, but yes, one can do option pricing, yes, but one can even leave it for the later impairment testing also.
Okay, ma'am. So, ma'am, normally in fundraising also, when we see the valuation reports, when they do it for the financial reporting purpose, they use the option pricing model, etc., and they come to a fair value. But when we talk about valuation for fundraising, always many people go for fully diluted basis and they divide it and then they come to a value which is different from the financial reporting value. So yeah, so in that scenario also we should just be stick to the fully diluted basis, or should we consider the option pricing value?
No, I think it's better to go with fully diluted model there. And when we look at for fundraise, because there will be certain formula which will be set in your your share purchase agreement or
Okay.
the investors agreement. So at what is the formula for the investment or the conversion of the preference shares. So I think one should rather implement that and look at the fully diluted model and do
Okay.
the valuation rather than do an option pricing.
pricing.
No, that will not be very good.
Understood, ma'am. Ma'am, next question is on the market price approach. When in the market approach, we have market price approach wherein we take the market price of the companies. So in the market, there are several approaches to this. People take current market price also. People take weighted average market price for 3 months, for 6 months. People also take volume weighted average market price for 3 months or 6 months. So what would you suggest as a preferred method to consider in comparable companies method and market price method for the valuation?
Okay, so when it comes to market price method, so I will say market price is used in several approaches, comparable companies multiple also, and market price itself as one of the parameters for determining the value of the company. Now, when we look at SEBI's regulation, it says that when there is an unlisted company merging into a listed company, the ICDR price is a bare minimum price that should be considered for the listed entity for issuance of shares. Okay. Now, ICDR price is 90 days, 10 days. So that is a pretty short period, and that actually sometimes I've seen that it just completely throws all the ratios and everything out of gear, because 10 days is a very short time. But ICDR pricing is 10 days and 90 days, and personally I would say that I would prefer to use a weighted average price rather than a volume weighted average price for the entire period. I would prefer to say to use say 6 months to 3 months depending on the time when you're doing the valuation. Why weighted average price? Because in weighted average price you find out the volume weighted average for each day, and then you do an averaging of that, so you have a weighted average price there. This takes away any skewness because of the heavy turnover, say on a particular day or a few days which have a lot of turnover. If you are taking a VWAP, that is volume weighted average price, where you do a complete, you have the total traded value and you have the traded volume of that period, and you find the value, then it can be tilted towards the price which was considered for the purpose of that heavy trading, trading days. So it's much better always to go with VWAP, which is weighted average price. Now, whether you should take 3 months or you should take 6 months, it depends on the time when you're doing the valuation. I always give this example of COVID. So when COVID hit in 2020, we were not aware of what was coming, okay? So that time, to take a much longer period, weighted average price was not tenable, because we didn't really, nobody understood. Even Damodaran, for the first time in the middle of the year in July, he came up with, I think, his new guidance. Otherwise, he always comes up only in December. But he came up in the middle of the year in July 2020. He came up with some new guidance that he had come up with. So COVID was a very different time. And so in cases where you have this type of an event, you may stick to a shorter period, because things would have undergone a big change. Now, supposing there is an election. So pre-election, normally the market would be quite suppressed, and because there is a lot of nervousness about who's going to come to power, any change in government, there's always some slowdown because changing of hands and everything. And so if we were to look at an election year, then it may be better to take a shorter period of say 3 months if you pass that 3 months post the election. So I would look at it in this fashion. Again, when we look at, sorry, just one more thing, post-election also, when we see, and we saw it even this time, that till a certain month, there was subdued demand, the economy looked very suppressed and everything, and that's because the spending of the government comes under a freeze before there is a period, and they cannot do any new launches, new projects and everything. And what I understand is the government spend is one very big, kind of catalyst for the economy. So when that comes under a freeze, then you have the fallout of that for next 6 to 8 months. And after that, the economy again bounces back. So if you are going to look at, some valuation, if you're going to do, say, in March or April this year, maybe you will not look at a 6 months, you might still want to look at a 3-month period.
So the current market price, to consider current market price not advisable. Yeah.
One day price, never.
Never.
No.
Understood. So the next question is on the football field which we prepare at the end, wherein we consider income approach, market approach, cost approach. So there, ma'am, when we talk about income approach, from DCF, normally we say it is a control value. But when we talk about market approach, ma'am, should we consider the price which we have received at the end as a minority marketable value? Because this is price which is been, the market price which we are considering there is traded by the minority shareholders. So should we consider that price as a minority marketable value or a control value? Because this has different opinion in the market. So
yeah, this is a highly debatable issue. I'll tell you why. Because market is always very bullish. Normally, the market is always very bullish, and it thinks that the companies are going to grow at 60%, 80% a year. That's a kind of multiples sometimes you see in case of companies. So when you do a DCF, as such, when you say that when you are doing a DCF, it is for the controlling stake. Because you have the full view, then you will take long-term growth and everything. But that most of the times, in case of India, I have found that most of the times DCF value is lower than the retail market value. Now, if we were to look at the theory says that market price is for retail investors, whereas DCF is for controlling stake, because you have the whole picture with you and you are giving a value based on that. However, when we look at the price, there is a premium in the market price, which is a retail price, and for the controlling price, you don't have a premium. So ideally, one should be applying a premium to the market price, but considering that the markets are so bullish most of the times, you see, when you do the working, however good, projections you may make for the company, most of the times your market price will always, overshoot the price you will arrive at under DCF. So although in theory one should apply a premium, but in practice it's very difficult to, do that.
Okay. Ma'am, the next question is related to startup valuation, a little bit on if there's a startup of which we are doing a merger and acquisition, something of that sort. So in case of startup valuation, we have ESOPs. And in the term sheet, we normally see the share price, the per share price, is after fully dilution of all the equity options which are there, which includes ungranted equity shares or ESOPs also. But when we do a valuation of a listed company or any company, as per the valuation norms, standards, we always say we have to take the ESOPs which are granted in the calculation of total number of shares. So in this scenario, ma'am, should we consider the total number of equity shares in the denomination, because the term sheet considers the fully diluted basis per share, and the valuation standard says only granted ESOPs?
In case of startups, the tendency is that the shares are issued for zero consideration. So there is no consideration which is paid by the employee. So there's nothing that they have to lose there. Now, if there was a company which is going to have some exercise price for ESOPs, which is there for all the listed companies, there one can say that depending on the type of company or how good the company is managed and how good the stock price has always been, one can take an assumption on whether or not, means all granted ESOPs should be considered, vested or unvested. Okay. In case of startups, I agree that one should consider all the ESOPs, because if there is, they will also have a tag-along right. So why would the employees leave out on the ESOP? So it's much better in case of startups, it should be taken on fully diluted, taking all the ESOPs granted, vested or unvested.
Okay.
That's how I would look at, because there's no cost now. Wow, there's
Correct.
nothing to lose.
Correct. So there's a debate in the market. People normally say, because we normally take listed companies wherein granted shares are only there. So, but at the same time, when we look at the term sheets, there's always total ESOPs, because the investor is also looking at the post-dilution shares which he's getting, or the stake which he's getting. So thanks for the clarification, ma'am. We should take the total number of ESOPs in case of startups when we compute the fully diluted per share value. Ma'am, couple of questions on the discounts. So so there's a scenario where if we are in the deal room, the company for which we are doing the valuation, if we apply a holding discount, they'll say that holding discount is not applicable. We have a brand value with our name, and why do you want to apply a holding discount? But in the normal parlance, whenever we talk about merger acquisition valuation, business valuation, in India we normally consider holding discounts. So ma'am, if you could tell us about the holding discount which we apply, how to compute the holding discount, and what references we can give to the client so that we can convince them that holding discount is applicable and this is how it works.
So, okay, so yeah, nobody would like to, accept a holdco discount. But the reality is always that when you have a tiered structure, there's always going to be a holdco discount. There are many examples you can see in the market. If somebody's done a structure where you have a holdco and then you have several very good subsidiaries under it also, you will find that the value of the subsidiary is not fully captured in the value of the holdco. Supposing you have a subsidiary that is listed, you have the holdco that is listed, and there are several other companies, you'll see that market always gives a discount, a holdco discount, and this is a reality. In fact, we do this exercise from time to time, where we try to find what is the holdco discount prevailing in the market, say at that time. So whenever there's some slack season, generally December end is a time when everybody is out on vacation. So maybe the team that decides not to go on a vacation might be testing on the holdco discount. And if we see the holdco discount, depending on the market at the times, if the market is very bullish, then the holdco discounts go up substantially, which means that the price of the holdco doesn't go up as much as the prices of the operating subsidiaries. I'm talking about where you can clearly see listed subsidiary, listed holdco. You can see that the proportion of change in the price of holdco and the subsidiary is different. So there is always a holdco discount because there are very many factors, right? Unless there is a collapse of the subsidiary into the holdco, which in fact in recent times many companies have done to realize the full value of the cream underlying operations of that holdco. But unless there is a merger where you don't take a discount because you are looking at it's a collapsing structure that you are looking at. So there you will not take. But otherwise, if you are just making an investment in the holdco, I think one has to stick to that holdco discount because there are so many leakages, dividend tax leakage. There will be, if there is sale of shares of the subsidiary, again there will be some tax leakage. Plus, you won't have full control as a shareholder of the holdco. You don't have full control over the operations of the subsidiary. Then the other problem is also the investor's nervousness. This is from the investor's angle. Any company which has also a subsidiary in similar line of operation, there is the investors get this, get jittery that we have invested in the holdco. It is quite likely that the company might do some additional business in the subsidiary and they will not let the holdco grow because they want the subsidiary to grow. And there, if you see certain companies over say 20 years time, you would have noticed, you can go through, you'll find that those companies have slowly and steadily diluted the holding of the listed holdco. There is another group company which keeps on taking a stake there, creates that way value for the group, but really at the listed company level, you are losing the value because then you'll see that the subsidiary company is growing much more than the holdco. So there is always a choice. So that's why there will be holdco discounts for several factors. It should be there.
Ma'am, one more question on the discount front. So, ma'am, when we talk about minority value, or when we talk about the unmarketable value, non-marketable value, we apply discount on lack of marketability. And we apply, in India, we normally see people apply directly 15% as discount on lack of marketability, which I guess is based on the Competition Commission of India's guideline, which was around 10 years back. So, ma'am, should we consider the same standard 15% discount, or should we use some other methodology to compute the discount on lack of marketability for the particular business which we are valuing?
Okay, so I think it's better to go with the convention which is followed because it's a very debatable issue. There is nothing like, okay, this can be established that this is the discount that should be adopted. So in case of unlisted companies, you should go with the convention, and the convention is something which is aging, it ages back almost more than 40 years, right? So right from donkey's years, we have always seen that in case of unlisted company, lack of marketability is taken at say 20%. In case of some of the guidelines of SEBI for mutual funds, it says that for working out the NAV, where the investments are in unquoted equity shares, the discount should be 75% in case of. So I would say at least a 15% discount is a good discount in case of unlisted shares.
Okay. Ma'am, one more thing. So when we talk about the level of values, the first is control value. Then we say minority non-marketable value. Then we say when we say, then at the end is not minority non-marketable. Then so first is control. Second is minority marketable. Third is minority non-marketable value. So in the first chain, we apply a discount for lack of control. In the second chain, we apply a discount on lack of marketability. So ultimately, ma'am, if there's a company which is unlisted company, and we are talking about a minority stake, there will be two discounts, which is discount lack of control and discount lack of marketability. At times, client doesn't like these approaches, and they say that why are you applying double discounts, be it 10% or 15%, which is reducing the whole value of my company. Ma'am, how should we tackle the situation, and what do you suggest in terms of discounts?
Okay, so I would classify into two parts only. One is that, see, it's an unlisted company, given, okay? It's an unlisted company, you have a controlling stake, you have a minority stake, okay? When it's a controlling stake, there is premium for control also. There is lack of marketability, but because there is premium for control, the lack of marketability gets knocked off, and that is where you can say that there should not be any discount when there is a controlling stake. Now, when we look at unlisted company, minority stake, then we should take a discount because minority doesn't have much say. In case of unlisted company, the majority will do what they want, and the articles of association also will be very restrictive on the transferability, plus there will be those shareholders agreements which will also have several restrictions on pricing and everything. So for minority stake in unlisted company, one should take a discount, but only one. You don't take two discounts.
Not discount lack of control and discount lack of marketability.
No,
otherwise, the value will reduce drastically. Okay, ma'am. Ma'am, so the next question is on the growth rate which we take for the terminal year. So normally in India we take 5% as the growth rate for perpetuity or terminal year. Ma'am, should we consider a higher growth rate because the GDP, the increase in GDP of India is more than 5%? Or should we stick to 5%, which is the cultural norm in India when we speak about valuations?
See, the growth in perpetuity depends on which sector you are looking at. Okay, so if you are looking at, say, financial services or broking business or something like that, what is the growth? Means the growth there would obviously be aligned with the growth that you will see in the capital markets over a longer period of time. Of course, I'm not talking about a 15% growth, but somewhere in the range of, say, 7 to 10% would be a good way to go about for, this kind of business, which is directly related to, capital market. Now, when we look at some other sectors like capital goods industry, there we may have a lower growth because even the nominal growth will not exactly match up with your inflation. So there can be there should be, I would say, a little lower growth there. That will be also evidenced from the way the projections have grown or how the revenue has grown over the project explicit period. So that is for the capital goods company. And then when we look at all these retail sectors and stuff, I have in fact debated with a lot of valuers in the past where people have said internationally we take only 3% and so we cannot take more than 3%. Now we are looking at Indian economy. Perpetuity also we are discounting, taking RFR of not lower than 6.5% or 6%, correct? If you are discounting your perpetuity also at 6% or 6.5%, or I think that is fair enough. Why would a businessman stay in business at that point at the end of the projected period, stay in that business, stay invested for a growth of 3% when he can otherwise earn a return of 6.5%, you know. So that has always been my argument, and now I find that most of the people have upped their growth. The international standards have been maybe modified for them.
Right.
That in India, it cannot be 3% growth, so we have to then align to 5 to 6% growth in India, because we have that kind of inflation and we are going to have that kind of growth in the economy. We have the growing middle class, so in the long run, there will be, you know, at least a 6% growth.
So ma'am, is it okay if we consider RFR, which is 6.5%, as the growth rate for the terminal year instead of 5% or 6%, or should we stick to the norm which is there in India of 5 to 6%?
That's a good question. So that way, when by taking a growth, you know, even 1% lower than RFR, you are kind of reducing the value of the company. But I think taking growth equal to RFR may look little upbeat, but I won't say that it will be very wrong. One can always defend it, you know, logically one can always defend it.
Because as per the valuation standards and the material which we have from ICI, it says that it should be lower than the nominal GDP of India. So the real GDP plus inflation is around 9 to 10% as per the records. So if it is lower than that, around 6.5, 7% based on RFR is okay, right?
It's a little too aggressive to go, but I think one can go up to 6% safely. Yeah.
Understood.
But again, it depends on the sector you are looking at.
Ma'am, we always kind of juggle when we talk about company-specific risk premium in the weighted average cost of capital. Clients ask us, how do you compute this particular metric, which we say it is based on a professional judgment. So, ma'am, how should we defend, or what consideration or what variable should we consider when we apply a company-specific risk premium, and how should we kind of defend it in front of the client?
So whenever I apply this company-specific risk premium, I always see like this, that okay, this is a company, established company, this is a cost of equity that company has, a listed established company has this cost of equity. Now here is another company which say is still just upcoming, there are many things, many challenges it is facing. As an investor, if I was to invest in that company's equity, what is the return I will be, I will, at what return will I enter into that investment? Because I'm taking such, you know, high risk, I'm taking that additional risk because a company is not established. So there should be, you know, premium which one should apply in case of different risks which are attached to an operation. Early, you know, it's a, you know, early stage development premium also will be substantial. In case of a startup, you will have a very high premium because it's a gamble. There will be at least 7, 8 startups in the same area, and it's just still a story. You don't know whether that's going to really succeed or not. So if it's an early stage, there are many other methods also which have nothing to do with the cash flows also. But if you are going with cash flow approach, which is little, you know, later than very early stage, but then you should have a high premium, 5, 7% premium should be there, because there's such high risk attached to, you know, that stage of development.
Right. Ma'am, so one more question is, when we compute the cost of equity for weighted average.
Sorry, one more thing.
Sure.
In case of company-specific premium, the other factor that one must keep in mind is, you know, what is the customer base, you know, the geographical exposure and all. So if one sees that there are certain other exposures, very small customer base, very high exposure to certain geographies where you see there's a big challenge, because then any time the operations can get affected, you know, substantially, and that is why you have to apply a higher premium there.
So, ma'am, the next question is on cost of equity. So, when we compute cost of equity in CAPM model, we use beta, and in beta, in market, many people, many small valuers use varied approaches. So should we, so many people use Damodaran as a base, they take the beta as on the start of the year, or they take beta but of 1 year, the average of 1 year. They take beta for weekly, they take weekly prices to consider the beta. And how, ma'am, how should we compute beta, and what should we take as a time span? Should we consider 3 years, 5 years, and what should be the interval, time interval? Should it be weekly, daily? How should we compute the beta so that we show the accurate risk which is there in that industry for the evaluation?
So let's start with daily beta. If one were to take daily price for computing the beta, then one can say that it is there'll be a lot of cancellations, so in that case, the beta will be substantially different from the beta that you will see in other models. Now, the other model of beta is you can take a weekly average price, not a one-day price again. Because I know that in many cases, many firms or organizations take monthly beta, which is just one-day price at the end of the month, and then the beta is calculated for the whole year. It's a very easy way of doing it, but according to me, not correct, because one-day price cannot be reflective. And I would say that it's better to take an average of a certain period, say a weekly, or monthly is again a too long period, but maybe a weekly period is always a better way to compute your beta.
And ma'am, should we consider 5 years or 3 years, or what should be the time frame to consider the prices?
So in current times, if you see every year something new is happening. So is this a new normal? We don't know. So because of so many things which happened, like COVID came, then the war, one war, second war, and things are just not ending. The inflation, now the US situation where it has very high debt. So there are so many ups and downs which keep on coming, and so in a period like this, it might be a better way to look at a longer period, but one can take 3 years at least. 3 years is the minimum, 3 to 5 years, depending on how the market and the world is.
Understood. But considering the Damodaran beta which is there on the website, it's not acceptable, right? Because that is...
I won't say, the thing is, Mr. Damodaran, Professor Damodaran, highly revered, like I really respect him a lot. But then, because this is big data, that he would be analyzing, and there would be certain processes or models which must be all ready-made fit in. So you don't exactly know how that beta is computed. So unless you know exactly how that beta is computed, it's better not to use that. Better to find out your own beta and work on that.
Right.
And in some cases, like you may put up to you may ask the person, you may ask the website that what is what are the assumptions taken in this beta. You can always ask, and in some cases they do answer, in some cases they don't answer. So if they don't answer, you'll have to work out your own beta.
Understood. So ma'am, last question from my end, then we'll open the floor for the audience if they have any questions on valuation front. Ma'am, when we talk about, so there's a wide acceptance in terms of application when we talk about leases. Because we know after Ind AS, there's a lot of changes which we do in the valuation in terms of operating lease. So ma'am, how should we consider the impact of operating lease in a market approach and a income approach? If you could just briefly tell everyone. So.
See, in market approach, because you may have data of the real lease outgoes for the target company you are valuing, but for the comparable companies, you will not have that data. In case of comparable companies, multiple approach. When I say market approach, I'm talking about comparable companies, multiple approach. Now let's elaborate a little more on that. What happens because of the standard is that the lease doesn't hit your EBITDA, it goes below the EBITDA. It hits your interest, it hits your depreciation, your EBITDA is higher to the extent of lease payment, but you don't know for comparable companies what is that element and how much is the actual lease which is being paid by that company. So in case of comparable companies multiple, you will have to take lease as a liability only. You will have to take that EBITDA, you know, after taking the effect of the standard. But in case of income approach, typical, which is DCF, income approach is DCF approach as per the valuation standards. And so under DCF approach, you can always ask your client to give you exactly what is the lease outgo. Normally everybody gives.